Hello, everybody. Welcome back. It's been quite a lot going on in the last month that we've been apart. Maybe we should have these every week. There's so much going on, to be honest. But we need to sort of suggest how to trade some of these geopolitical events with all that's been going on in the Middle East recently. And that is really important now to focus on. So how do you trade these geopolitical events? These events often happen by surprise. So being prepared for them is very difficult indeed. So look, they happen. So wars, conflicts, terrorist attacks, you name it, they happen, but they're usually something of a surprise. So there is no preparation you can do for this. All you can do is learn how to trade through them. And that is what we want to try and focus on today. So this is really important. Once they happen, financial markets can react strongly. And so what we get is what we call increased volatility. Markets whipsaw around, they gap. These are dangerous times. And you need to be aware of things to consider. So first of all, it's a matter of understanding the event. Now, this seems fairly crass, but to be honest, it matters because all these events are different and therefore they impact different markets in different ways. Some continue, others pass quickly. So understand and anticipate potential market reactions. Which markets are they going to hit hardest? And assess your timing. For instance, buying gold 2 weeks after the event when it's moved 5 or 10% is pretty pointless. So we need to be flexible. We need to understand the event. We need to learn about it very quickly, but also check your charts and consider current market moves. Is the market particularly one way in some market? Like, do we have a very big bond position out there? Is the market long dollars? Assess these because in times of stress, we often see markets rebalance and people move to the sidelines and look for safe havens. More on those later. But news headlines will be coming at you fast and furious. Keep those on your screen because they are going to move markets every time they come out when this is still raw to the markets. So be aware of that. These geopolitical events are not easy to trade. There is opportunity in them, but you need to get hold of the event itself and understand it. So things to consider. So what are the countries or regions involved? This does matter because if you look at Russia, Ukraine, there was a commodity structure to that. We had the grain that comes out of Ukraine. We have the oil and commodities that come out of Russia, Israel, Hamas, Middle East issues. So oil, is that going to spread? If that expands, there is going to be serious implications, a lot larger than we're seeing at the moment. So ask yourself, is this a localized event? Is it regional? Is it global? And these things matter because if they're localized, markets have a habit of moving on. But if they are regional or global, sucking in other nations, then things can expand nastily. And we need to understand the potential market implications. So we need to look at oil because of the situation in the Middle East at the moment, but often this gets hurt, gets moved, but also safe havens and what those safe havens are. So if we look at the chart at the bottom here, we've got a 4-hour chart from October the 1st to November the 7th. Now you can see the Israel-Hamas event down here on the left where this arrow is here, and you can see that gap. Now, this is the danger with geopolitical events. Some of them happen over weekends. Now, this was a Friday to a Monday. Look at that gap. If you were short oil, and let's face it, oil was trending down at the time, then this would have hurt. This would have hurt a lot. And some of that move above that was people getting stopped out, but also a general fear that an escalation through a deeper regional crisis would see oil impacted quite hard. So these are things to consider. Not easy to predict, but the impacts can be quite large on the market movements. So we saw regional escalation concerns continue to drive oil up towards $90 a barrel. And then we started to drift off. Now, this is basically the market saying, okay, it looks like it's being contained at the moment. We saw the US foreign secretary going out there trying to sort of contain this. And markets very quickly decided to focus on a different area, and they started looking at global demand. Some of these economic data started moving lower in the US, Europe, UK, China, and basically the demand issue started to override the geopolitical tensions out there, and oil started to fall. And you can see that we've come down again. But let me just say here, these geopolitical concerns haven't gone away. Again, I would be very cautious of having an oil position or any positions that are ignoring these risks over any weekend. And in fact, apart from last Friday, we have seen most weekends, most trading days into the weekend, seeing demand for havens again. So general risk is easing at the moment, but it may not have gone away. And I think part of that is why we've seen gold hold up relatively well, although that also is coming off and has been seen as a safe haven at the same time. So safe havens are assets expected to retain or increase value during times of market turbulence. Examples we have: gold, other precious metals to a lesser degree, but silver also moved this time. The Swiss is always seen as a safe haven. And the big one is really US government bonds and the US dollar. This is the safest government bond market out there, and the dollar is the reserve currency of the world. And so these are deep waters, calmer waters, if you like. And gold has risen 10% since the geopolitical events in the Middle East started, which shows you that in times of real stress, gold is still there as something that can be seen as a cover. And again, we saw that gap up at the weekend when Israel was hit by Hamas. And then we've actually seen a more continued rise. If you remember that chart we saw on oil that rolled over quite quickly, the regional escalation concerns are still there in gold, although we have started to sort of drift back as the trade gets a little tired. We're not seeing an escalation at the moment. So it does ask the question, what now? But again, into the weekend, we may see gold start to pick up again. So I think this pullback is traders getting a little nervous that hopeful that the escalation has not happened yet. But that doesn't mean to say with what's going on, it won't. There are certainly issues going on in Syria now. There are certainly issues in Lebanon. And these cross-border conflicts are not going to help. So how many fronts is Israel going to fight on? We don't know. Could this drag in other people? We don't know. This Middle East story is still playing out, and the fear is still of a wider escalation. But at the moment, markets believe this can be contained. Gold is still finding buyers on dips, I think. Certainly into the weekends, you'll see that. But also on a more global macro basis, we are still seeing some of the central banks buying gold as well, so particularly China. So it's an interesting market. There is opportunity here, but the risks are high, and I think we need to stress that very clearly to you all. General risk sentiment can also be impacted depending on the parties involved. So obviously, if you've got people like the US, China, Russia, and Europe, and the oil producing states, these are major players. They're all nuclear capable. So, we've got tensions between the US and China. We've got tensions between Russia, Europe, and the US. We've got problems with, what's going on in the Arab world at the moment. So there is still a lot of risk out there. And these actually have potential impacts on global growth. So I think what the problem is here is that there's an awful lot of spending having to go on military. Governments are still spending more debt, more issuance to come. It's a very difficult market. But if we look at the USA 500 chart from October the 1st, we saw that gap down again, the opposite to what we saw in oil and gold. We gapped down quite steeply. And again, markets were getting long stocks. This hurt. But look how quickly we bounced back. I mean, it was quite incredible. Now, there's a few other things apart from the geopolitical tensions there that we saw weaker yields in the US and a Fed that was sort of slightly leaning towards suggesting that they may be done hiking now. And the markets wanted to get past this geopolitical problem. But then again, it comes back and, geopolitical concerns still add to general negativity around global indices. But again, as we start focusing, making those lows around 41.22 on October the 27th. Since then, we've managed to see quite a decent rally because the market has focused back on what the Fed is doing. They've moved on. Equity markets have clearly moved on from the risks of geopolitical tensions in the Middle East. Whether that is right or sensible remains to be seen. But at the moment, equity markets have put this behind them. But those moves at the start of the crisis would have been very difficult to trade and very difficult to predict. A lot of people would have suggested that stock markets would have gone straight down and kept going. They didn't. We've had a really choppy session. So volatility is a bit of a problem here. And it's going to be difficult to trade from here on in as well. There's no guarantee this is past. So managing risk over geopolitical risk is something we have to talk about. So how do we trade these things? Well, for a start, they are highly unpredictable, and therefore market reactions are certainly going to be volatile. So on that, we need to risk manage your existing positions. So when you understand the event, you need to ask yourself, do I have the right positions to reflect what's going on? If I don't, get out of them. Reassess your risk allocation for new positions. Maybe you've got the wrong position and you need to close out and put a different one on. And also, in accounting for bigger and more extreme moves or reversals, you need to reduce your position size. And when you do that, it allows you to put your stop losses further away to hopefully keep you away from some of this volatility in the markets. So it is really important that you take this as a game changer in the short term at least. Adjust your views, adjust your positions, adjust your trading size, and really be careful out there, because these events, although difficult to see coming, can offer opportunity as long as you've got dry powder to play with. It's about keeping you in the market. And so stop losses are essential, even though they may be wider apart, but reduce your position size, because there is no linear effect of these events. And it's very difficult to predict where markets go once they've happened. So that's it for me for another month. I would love to see you a bit before then, because I think we've got a big month coming into the end of the year as well. But I'll be back in about 4 weeks' time. I hope you have a great trading experience between now and then, and I'll see you later.